Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2025, May-June, Paper 4-1 and Paper 4-3, question number 1. This is the structured Paper 4, which consists of 2 questions. Each of them will be of 25 marks and the total time limit for the paper is 1 hour. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. Wahid wanted to start a project to tap into expanding leisure industry. He decided to buy the fishing rights for a nearby river and then sell the right to fish in that river to individuals via ticket sales. He thought he could also rent out some fishing equipment. He was unsure whether he would sell day tickets or annual tickets. He provided the following information. The fishing rights would cost 57,000 at the start of the project and last for 4 years. So the lifetime of the project is for 4 years and 57,000 is the cost incurred at the start of the project. So this will be our initial outlay or the initial outflow. Wahid thought the fishing equipment he would rent out would have a life of 2 years. Therefore, he would spend 5,000 at the start of the project and 6,000 at the end of year 2. Okay, so this 5,000 is also to be incurred in year 0 because this is the start of the project and 6,000 at the end of year 2. Alright, then fixed cost consisting of advertising and the employment of an assistant to handle the sale of the tickets were expected to amount to 9,800 in each of the years 1 and 2, 9,400 in year 3 and 9,100 in year 4. Wahid estimated that the variable administrative cost would be 0.80 for each day ticket sold in the years 1 to 3 and 0.90 for each day ticket sold in year 4. If he decided to sell day tickets, his estimates for sales were as follows. We have the number of day tickets sold as well as the price per day ticket. Okay, then Wahid would charge 10 per day for rental of the fishing equipment. He estimated that 20% of purchasers of day tickets would also require the equipment rental. Okay, so 20%. We need to figure out 20% of the number of day tickets sold for each of the years 1, 2, 3, and 4 as well. Let's do that first. So the 20% of 660 will be 132. 20% of 740 will be 148. 20% of 900 will be 180. That will be for both year 3 and year 4. Then these number of tickets would also pay for the rental of fishing equipment, which is 10 per day. Let's take a look at our first question. We need to complete the following table by calculating the net cash flow for each year of the project. So I'll do it in the next one, this one. So we have 4 years for this project. So the years will be 0, 1, 2, 3, and 4. For the cost, we only include the initial cost, which is to get the rights for fishing. We have it right here, that's 57,000. So that will be the cost for year 0. And we have to pay this. So this will be negative because this is a cash outflow. Then we have equipment. Okay, for equipment as well, we have been given the information. He would rent out. The fishing equipment would have a life of 2 years. So we would have to spend 5,000 at the start of the project. So this will be included in year 0 and 6,000 at the end of year 2. So this will be included in year 2. Let's write it down. And we have to pay both of these values. So these will also be negative. 5,000 at the start of the project, then 6,000 at the end of year 2. Okay, then we talk about tickets. So the information regarding tickets were also given clearly right here, the number of tickets sold and the price per day ticket. So we just need to multiply these two together. For year 1, that will be 660 times 30, which results in the value of 19,800. Let's write it down. Then for year 2, that will be 740 times 40, which results in the value of 29,600. Then for year 3, that will be 900 times 40, which results in the value of 36,000. And the same applies for year 4 as well. Let's write it down. So we have 36,000 and 36,000. And the tickets will be positive because this is the income that we will be getting by selling the tickets. Then we have rental. So rental is just the expenses. So rental will just be for this information. We will be charging 10 per day for rental of the fishing equipment. So this will also be part of our inflow. So we need to include this as a positive figure. And we've already calculated the number of day tickets sold that would also require rental of the fishing equipment. So in this case, we need to multiply all these values by 10. So for year 1, that will be 1,320. For year 2, that will be 1,480. And for year 3 and 4, that will be 1,800. Let's write it down. So 1,320, 1,480, and 1,800. Okay. Then we have the fixed cost. So fixed cost, we will have to incur it. So this will be our cash outflow. We need to show it as a negative figure. And fixed costs were given clearly right here. It is to be expected to be 9,800 in 1 and 2, 9,400 in year 3, and 9,100 in year 4. Let's write it down. So 9,800 in year 1, 9,800 in year 2 as well. Then it will go down to 9,400 in year 3 and 9,100 in year 4. Okay. Then we have administrative costs. Again, these are the expenses that we need to incur, so we need to show it as a negative figure. For administrative cost, we have information right here. It would be 0.80 for each day ticket sold in the years 1 to 3 and 0.9 for each day ticket sold in year 4. Okay, so for year 1, that will be 660 times 0.8, which results in the value of 528. Let's write it down. Okay, we repeat the same process for year 2 as well. For year 2 as well, the value will be 0.8 per ticket. So that will be 0.8 times 740, which results in 592. Let's write it down. Then for year 3 as well, the value will be 0.8 per ticket. So that will be 0.8 times 900, which results in the value of 720. And for the last year, the value is 0.90 for each day ticket sold. So that will be 0.9 times 900, which results in the value of 810. Okay, now we need to figure out the net cash flow. So net cash flow will just be sum of all of these values for each year. So for year 0, that will be negative 57,000 minus 5,000, which results in negative 62,000. For year 1, that will be 19,800 plus 1,320 minus 9,800 minus 528, which results in 10,792. For year 2, that will be negative 6,000 plus 29,600 plus 1,480 minus 9,800 minus 592, which results in 14,688. For year 3, that will be 36,000 plus 1,800 minus 9,400 minus 720, which results in 27,680. And for year 4, that will be 36,000 plus 1,800 minus 9,100 minus 810, which results in 27,890. Alright, that is all for the first part. Let's move towards the next one. We have some additional information. Wahid has a cost of capital of 10%. The discount factors for this are as follows. We need to calculate the net present value of the project, assuming that day tickets are sold. So we have our years 0, 1, 2, 3, and 4. So in order to calculate the net present value, we simply need to multiply all of our net cash flows to the discount factor at the rate of the cost of capital, which is 10% in this case. So we can first copy down our net cash flows. Let's take a look above. That is negative 62,000, 10,792, 14,688, 27,680, and 27,890. Let's write it down. So negative 62,000, 10,792, 14,688, 27,680, 27,890. Then we need our discount factors. So in this case, the discount factors are at 10%. So for discount factors at any rate, for year 0, it will always be 1 because we do not need to discount the value for year 0. Now for the remaining years, 0.909, then we have 0.826, then we have 0.751 and 0.683. Then we multiply these two together and get our present values. So for year 0, that will be 62,000 times 1, which again results in 62,000. For year 1, that will be 10,792 times 0.909, which results in 9,809.928. For year 2, that will be 14,688 times 0.826, which results in the value of 12,132.288. For year 3, that will be 27,680 times 0.751, which results in the value of 20,787.68. And for year 4, that will be 27,890 times 0.683, which results in the value of 19,048.87. Now, in order to figure out the net present value, we need to add up all of the present values. So that will be minus 62,000 plus 9,809.928 plus 12,132.288 plus 20,787.68 plus 19,048.87, which results in the negative value of 221.234. And in this case, the final answer can be rounded off. So the net present value can just be rounded off to negative 221. Alright, that is all for the second part. Let's move towards the next one. We have some additional information. Wahid was also considering selling annual tickets instead of day tickets. All of the calculations that we did previously was for the day tickets. His best estimate of the sales of annual tickets was as follows. So we have the number of annual tickets sold as well as the total revenue. Wahid estimated that the income from renting out fishing equipment would be the same, whichever type of ticket was sold. Wahid feels less confident about his projected revenue figures under this option. Now we need to advise Wahid whether he should sell day tickets or annual tickets. If he goes ahead with the project, we need to justify our answer. A recalculation of the net present value with annual tickets is not required. Alright. This is of 7 marks. So we need one final decision and 6 different comments. So the very first thing we can do is talk about our calculation regarding the day tickets. We can see that the net present value is negative, and whenever any investment project has a negative net present value, we suggest not to invest in such projects. Let's write it down. Selling day tickets leads to a negative net present value, which indicates that this should not be undertaken. Okay, the second thing we can do is compare our revenue. Let's take a look at the revenue of our day tickets. That's 19,800, 29,600, 36,000, 36,000. Let's figure out the total in this case. This results in the value of 121,400. Now let's take a look at the revenue from annual tickets. That's 20,000, 30,000, 40,000, and 40,000. Let's figure out the total in this case as well. This results in the value of 130,000. So clearly the revenue from our annual tickets is higher. Let's figure out the difference as well. So the previous value was 121,400 minus 121,400. This results in the value of 8,600. And remember that the net present value from our day tickets was only negative by 221. And in this case, since the revenue is higher by 8,600, we can confidently say that the net present value from annual tickets will be positive. Let's write it down. Selling annual tickets gives a higher revenue of 8,600. from the ticket sales. As a result, this would improve the net present value and also cause the net present value to be positive. Okay. And we also need to consider the expenditure as well. So when we consider day tickets, we had the administrative cost, the variable administrative cost. And this was when we sold the ticket on a daily basis. But if we were to sell annual tickets, then the variable administrative cost would also decrease because the salaries might be reduced. Let's write it down. Selling annual tickets will cause the variable administrative costs to fall due to the reduction in staff salaries. All right. Then we can also see that all of these revenues shown from both the annual tickets as well as the day tickets are based on estimates, and there is no certainty over how many tickets will be sold of either type. Let's write it down. The NPV calculations are based on estimates, and Wahid has no certainty over how many tickets will be sold of either type. Okay, we have 5 comments. We need one more comment. Now, we also need to talk about the confidence of the investor because all of the numerical values are solely based on estimates. And in this case, if Wahid is less confident about the sales of annual tickets, then the risk of this investment definitely increases. Let's write it down. If Wahid is less confident, and Wahid being less confident is given above. We're not just making anything up. Wahid feels less confident about his projected revenue figures under this option, which is the option related to the annual tickets. That's what we're connecting here. So if Wahid is less confident about the sales of annual tickets, then the risk increases. Now, based on these factors, we need to make a final decision. So in this case, I would advise Wahid that he should sell annual tickets if he goes ahead with the project solely based on the fact that this has a positive projected net present value. Let's write it down. Wahid should sell annual tickets if he goes ahead with the project as this option has a positive estimated net present value. All right, that is all for the third part. Let's move towards the next one. Again, we have some additional information. Wahid's brother uses the accounting rate of return when considering his projects. We need to see 2 advantages and 2 disadvantages of using ARR. Okay, so the accounting rate of return formula is just our average profit divided by average investment. And we need to give our value in terms of percentage, so we also need to multiply this by 100. So the very first advantage of using ARR is that it is simple to calculate as well as to understand, because we're only using the profit figure as well as the investment figure. So this is simple to calculate and understand. And it is also simple because there is no involvement of the discount factors. Then another advantage of using ARR is that multiple projects can be compared. Like I said before, the accounting rate of return value will be in terms of percentage. So we can just compare the percentage of ARR from this project to the percentage of ARR to another project in order to determine which project should be undertaken. Let's write it down. Multiple projects can be compared. Okay, now for the disadvantage, we only consider profit, not the cash flows. And profit can be subjective, whereas cash flows are objective. So that is a major disadvantage of using ARR. Does not consider cash flows. Then another disadvantage is that it does not consider any of the discount factors, which means we are not taking the time value of money into consideration. Let's write it down. Does not take time value of money into consideration. Alright, that is all for the fourth part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.